Assalamualaikum and hello everyone. I am Madam Yusnul Liza. If you are new here, welcome to my channel. If you're returning, welcome back. Today we are going to learn on how to prepare the financial statement which will be using the sample final exam question February 2021, and this is for FAR 270. Preparation of financial statement in this FAR 270 will require you to prepare the statement of profit or loss and other comprehensive income, statement of changes in equity, statement of financial position, and some notes to the accounts. So you're not going to ask to be prepared to prepare the statement of cash flows. Okay, here it will only focus on this three statement, which is the statement of profit or loss, statement of changes in equity, and statement of financial position with some notes to the account. And we are doing this question if you can see, there are marks that are being allocated for this particular question. It's 30 marks. So for 30 marks, you should be spending around 54 minutes. 54 minutes. So let's look at the question first. So this is a question where you are given the company called Galaxy, and we know the requirement just now. You are asked to prepare that. So what you can do first is, this is something that is the third time that you may be doing for a company financial statement. The first time might be in FAR 160, second time was in FAR 210, and this is the third time in FAR 270. So we have the MFRS that you may have to cover in this particular preparation of financial statement is whatever that you have learned in FAR 160, 210, and of course what you cover in this particular course FAR 270. So the company is having a focus on consumer product and the financial year of the company. So if you look at the financial year of the company, that was 30th of June each year. So this is the reporting date. So reporting date is 30th of June, and the directors authorized the financial statement for issue on 1st of October 2019. So this is the authorization date, the date where the financial statement was authorized for issue, and this is the reporting date. And if you know, this gap between the two dates are the whatever you will relate to events after the reporting period. So that is the post-reporting date. So you have the trial balance there. So you have the usual item, the common item that you may have come across before. So for example, you have the first item. This is going to be shown in the SOPL. This will be in the SOPL. These are all in the SOPL. So you need to be able to classify. And if you are interested to go into detail on this, you can also refer to my FAR 210 video. Go check down in my channel. So this will be in the soft B. This will have to be adjusted, yeah, and the tax paid later will have to be adjusted, and this will relate to the item in the SOPL. So we need to go and do adjustment on that. On share capital, in the statement of changes in equity, retained earnings, statement of changes in equity. Long-term loan, this is under your statement of financial position, your non-current liability. Property, plant and equipment, it is your non-current asset. Non-current asset as well. Those two things here, soft B. Asset revaluation reserve will be in your statement of changes in equity. This is the previous balance, which is a credit balance. And this one will relate to asset that were being subsequently measured using revaluation model. Investment, this is going to be under your statement of financial position. This is also the same thing, only that this is your current asset. Same goes here. And this will be adjusted in the current asset section with the trade receivable. Same goes for statement of financial position. Item here is the bank balance, current asset. Investment property, non-current asset. This is current liability. All these will be in your statement of profit or loss. Okay, then be careful with the classification. And for tax paid, partly will also be related later when you do your adjustment. That will also be part of the items to be shown in the statement of financial position should you obtain a tax recoverable or tax payable. So let's look at the first information and we'll do the adjustment for the additional information before we go on doing the requirements. So there are like 7 information here, but if you notice, information in information number 3 has a lot of things that you need to settle. So let's do number 1 first. So information number 1, and you can see next to this particular question, I have also put some item which is related to the journal. So you have number 1, included in the revenue figure. Revenue figure here is a credit sale. So the revenue figure includes credit sale, which was only delivered on 10th of July. 10th of July is whatever that was delivered after reporting date. Remember, reporting date was 30th of June 19. So that should not be recognized in the revenue. And that has been delivered to the customer. Is it? No, but it was only delivered on 10th of July. But somehow you have recorded your sales, and therefore your revenue figure has been overstated. So what you need to do is you need to go and restate the revenue, and these goods were included in the closing inventory. So no adjustment is needed in the closing inventory because you have not yet actually adjust the closing inventory with the goods that are being sold. So you need to adjust first the revenue figure and then the trade receivable with the amount that has been overstated. So you need to go and restate the revenue. Next, second one, 2nd of August, Diamond, which is your customer, owed Galaxy 250,000, was declared bankrupt. That was one of the reason that you will normally write off our accounts receivable as bad. And you are informed that it was very unlikely that Galaxy, which is the reporting entity, would be able to collect any money from Diamond. So normally when you are able to collect, you will still go and collect from them. But here it was unlikely, and that is going to be written off as bad. Under allowance method, if you write off as bad, that will be debited to the allowance for impairment account, your AFITR, and 250,000, and it will be adjusted in trade receivable. And trade receivable that you will have to adjust here is trade receivable of Diamond. Not all trade receivable, just the one of Diamond. Next, this is the information regarding PPE. We have the schedule, right? Schedule of movement of PPE, not for this year, but for the prior period, which is on 30th of June. No adjustment has yet been made for the property, plant, and equipment for the year ended 30th of June 2019. This is our reporting date. So the schedule for 2019 has not been prepared, and you need to prepare later because that is one of the requirements. Before that, these are the schedule for the year ended 30th of June 2018, which is last year. So every figure that you have here is starting from 1st of July 2017 until 30th of June 2018. So you can check that there are land, building, and machine. So you have few items here that I have already highlighted. You can see that I have used different highlighters. For the machines, I use yellow. For building, I use pink. For the land, I use the green color there. So let's look at what you have. And I'm going to start off with the non-depreciable asset first, which is item 3B. This is 3B. I'll be doing that. I've done this and this and this now. So I'm doing B. The land was revalued for the first time. So this is actually the first revaluation, or you also call them initial revaluation. That was revalued the first time on 30th of June 2018. So if you look in the column here for land, this is actually the first revaluation, and you have the surplus for land. Okay, then you go on reading them. On 30th of June, the land was revalued again, and this time it resulted in a deficit. For the first time, initial revaluation was a surplus, and that was 500,000. For the second time, this is the second and subsequent revaluation, right? Second revaluation, that was 700,000. So if you recall MFRS 116, for first revaluation, you will, if it's a surplus or deficits, you are going to directly record them according to the requirement. But for here, you can see first time revaluation, there was a surplus, you have already recorded them in land account, and you have credited the asset revaluation reserve. How do I know? Because in your asset revaluation reserve, there is already a balance of 500,000. So that shows that it has been credited. So there was enough balance relating to the same land, and now the land was being revalued. There is a deficit, 700,000. So what you need to do is, for that 700,000, you need to first utilize the whatever balance that you have, 500,000. Right, so the land balance has 500,000. So the deficit should be first debited to the ARR of land. Since there are enough balance, is it? No, 500,000 only. Your deficit was having a figure of 700,000. So the remaining will be debited to the revaluation deficit. But first, you must fully utilize the revaluation reserve relating to land. So 500,000 will be debited to the asset revaluation reserve, which means that, let me just write a little bit, this will also be adjusted in the OCI in your SOPL. So in the statement of profit or loss other comprehensive income, the other comprehensive income also needs to be reduced by 500,000. The revaluation deficit will need to be adjusted to the SOPL by adjusting the admin expenses. Do not debit everything to the asset revaluation reserve, because that is not enough. So therefore, your land later will have been reduced by 700,000. Okay, we'll do that later when we prepare the statement, but let's just do the adjusting entry first. So we have done 3B. Now I'm going to look at the item in A that also relates to the building. So item A, number A here, let's just focus on the building first. The building, so later we'll read things on machine, right? The building is depreciated on a straight line basis over an estimated useful life. So for your information, when you do the revaluation, right, you also need to continue your depreciation, but your depreciation will now be calculated based on the new value. So what you will do is that for the year ended 30th June 2019, the building is still being depreciated, but it will be depreciated at the new value. And if you look here, the building was revalued to 7 million, right? It was revalued to 7 million. So what you will do now is that you're going to calculate the depreciation. How do you calculate the depreciation? Okay, if you would see, before this, the building was 7.5 million. 7.5 million, which is the cost of the building, which is also on 1st of July 2017, as well as cost of the building as at 1st of July 2018. So the revaluation took place on 30th of June 2019. So for the current year depreciation, which is from 1st of July 2018, 1st of July 2018 up till, let me just show some workings for you, up till 30th of June 2019. So I'm going to put the working here. Just show some time for you. 1st of July 18 up till 30th of June 19. The revaluation will still be based on the cost. Why cost? Because the second revaluation took place on 30th of June 2019. So for the whole year, your depreciation is still based on the previous amount, which is 7.5 million. So 7.5 million here, if you look, if you divide it by 50 years, which one is 50 years? Just look at that information given here, 50 years. So the useful life was 50 years. So you divide by that, you have 150,000. And credit accumulated depreciation building 150,000. You will do that first. Next is that you are going to do the revaluation. Yeah, you need to go and eliminate the depreciation of the building before the revaluation. So for the revaluation that is now revalued at 7 million, the accumulated 750,000 will have to be eliminated, and that has to be added with the depreciation for the current year. So therefore that depreciation will have to be eliminated. So the balance brought down, which is the amount of accumulated depreciation as at beginning of the year, 1st of July 18, and current year depreciation 30th of June 19. So 150, it will be 900,000. That will be eliminated. So how do you eliminate? You go and debit account depreciation, which is accumulated depreciation building, yeah, based on the cost that you have here, or the valuation figure. Actually 7.5 million is the valuation figure. So therefore you will see that the amount would be 900,000. Okay. Now you will do the second revaluation for the building. So we are dealing with the building, right? The building. Land, no problem. We have already done the adjustment for land just now, right? Now we are doing for building, where the building, the revaluation was 7 million. And this is the first revaluation for building. First revaluation. You can see here, I put here 3B to 3, which is first revaluation. For the first revaluation, you will debit building and you will credit asset revaluation reserve of the building. So building was never being revalued. So this figure that we were showing here is all at cost. No valuation figure yet. So after 30th of June, then only you have the valuation figure. So how do you do that? You're going to use your knowledge that you have learned in MFRS 116. Take the fair value, fair value is 7 million, the figure here, and minus the carrying value as at 30th of June 19. So to get the carrying value, you take the cost, which is the cost of the building here. This is the cost, 7.5 million. And you adjust with the accumulated depreciation that has been eliminated. This is because you want to find what is the carrying value on the revaluation date, which is on 30th of June 19. So that would be the figure there, 7.5 million minus accumulated depreciation 900. So you will get 7 million minus 6.6 million, because 7.5 minus 900 is 6.6 million. And with that, your figure would be 400,000, because the figure here is 700 and the figure here is 7 million actually, and the figure here is 6.6 million. So we have the building, which is 400,000. Debit building, credit asset revaluation reserve, which means that this also need to be reported in your other comprehensive income. Remember, here you are going to go and credit, and you are going to show them in other comprehensive income and add to the other comprehensive income. Next, however, don't get confused with this. This one is where you will reduce that later. Next, we're going to do for the last part, for the machinery. Machines are depreciated 10% reducing balance method yearly basis, and it should be read together with part C here, where there was a replacement of a component of a machine. I believe you have already read the question. The 1st of July, the components, some of them required to be replaced. The company decided to replace with a new component. The new component was 600,000. The old component was 800,000. And the old component was purchased 2 years ago. Okay, so the new component was paid by check, so that will also involve some cash out of your company. So, and you are informed that replacement will increase the performance. So if the replacement increase the performance, it has to be capitalized, or it has to be added, that 600,000, to the cost of the machine. So let's look at the machine here. So this is something that you have covered in FAR 116 in your first 2 weeks of the learning of the topic. So 1st of July 2018, replacement of old component. We need to go and replace. So we need to go and de-recognize the machinery's component that were being replaced. So we will credit the machinery 800,000 with the old component. And the accumulated depreciation related to the old component that are being replaced must also be eliminated. So it will be 152,000. You can check the calculation that I show here. 10% from 800,000 is to calculate the depreciation based on reducing balance method. So you have that for the first year, and you need to do it for 2 years. Why? By the time you replace the old component, it was just being purchased 2 years ago. So you need to go and find out the accumulated depreciation for the 2 years. Okay, so that 2 years, first year is going to be 80,000, and the second year would be based on the carrying amount. So to get the carrying amount, another way of doing it is by taking 800 times 90%, which is to find out the carrying amount. And on that carrying amount, you will have to provide 10% depreciation charge, since the depreciation is reducing balance yearly basis, and therefore you get 152. And if you compare 800,000 with 152, the difference is the loss on disposal of the component being replaced. That should be reported to your admin expenses, because this is item in your SOPL. So let's look at the third part, which is the machinery being purchased. For the one being purchased, you paid by check, so debit machinery with the cost of the purchase, or the cost that you paid for the new component, 600,000, and credit bank. So go and adjust them later. Of course, in your schedule, for all the items related to the PPE, go and adjust in the schedule when you prepare the movement, the schedule. Right? And for bank, go and adjust in the bank account. So the next item is to calculate the current year depreciation based on the after the component is being replaced. So meaning that what is the carrying amount at the end of the current year, 30th of June 2019. So your duty is to make use of what you have learned in the MFRS 116 in the first 2 weeks, where you need to find what are the carrying amount as at 30th of June 19. I've shown you the working here. You can check them. First, find the carrying amount on the replacement date, which is 3661470. Replacement date is 1st of July. And then remove the old component. Remember, old component is 800,000, this one. And add the new component. This is the new component, 600,000. And again, you need to go and add the accumulated depreciation of the old component, and therefore you will have the figure 3613470. So if you do that, right, if you do that, you will see that the carrying amount of the machine would be 3613470, and therefore you'll be calculating your depreciation, and you'll multiply it with 10%, and that one would be 361,347. So that is how you calculate for that. Remember, this is not what you have to learn here. This is what you have learned before, right? And make sure you still remember that. Okay, so let's proceed and look at the next one, which is adjustment number 4. You make sure you understand that. This is also a revision for the first part of the syllabus. 1st of August, net realizable value. So this is from what you have learned in FAR210, where the net realizable value of the inventories was valued at 35 million. So the cost of the inventory, if you check here, is 40. So it is now being revalued to 35. So therefore, you need to write down the inventories that are being written down would be 5 million. So debit cost of sale in the SOPR credit inventory. The last, the item number 6 now, item number 5, sorry. The company adopts fair value model. Remember, under fair value model, if you adopt for IP, there is no depreciation, there will be no impairment. On 1st of July 2018, the company decided to use the building that was classified as an IP as its warehouse. So now the investment property will be reclassified due to the transfer, in terms of transfer in the change in use. So this is a transfer in terms of change in use. So to becomes warehouse mean that is going to be a PPE. Yeah, so the building will now be used as PPE, and the fair value of the building on the day of transfer, 1st of July, was 4.2 million. And remember, if you use your IP, now it becomes a PPE, you will have to depreciate for the building that is a PPE. But you won't depreciate for the building that is an IP because it uses fair value model. Okay, 4.2 million. The remaining useful life was 30 years. So how do you do that? You can see here. First is to transfer. So when you transfer the building, you will transfer the building here, 4.2 million, debit the amount that is now being classified as PPE. So building PPE, 4.2. Remove it from building that is an IP, also 4.2 million, right? And therefore, what you will do is that will transfer the IP to PPE. The next one is to record the gain on fair value on the change of IP, where the building, if you can see, the carrying amount of the building was 4 million. So you can go to the your trial balance. You can check your trial balance. The carrying amount was 4 million when it was an IP, and when it was transferred to become a PPE, the fair value was 4.2. So the difference between that carrying value and the fair value was 200,000. So there is a gain in fair value change. So that is when it was still an IP, debit building, IP portion. Of course, IP at that time, and credit gain or increase in fair value change 200,000. The next part is the depreciation part. That is for the building that is being classified now as an item of PPE. So go and provide depreciation for that building that is now a PPE, debit depreciation, credit accumulated depreciation. Take the 4.2 million, the fair value, divided by the remaining useful life, 30 years, you have 140,000. This will be under your SOPL, of course under your admin expenses, and this has to be adjusted when you prepare your notes. Number 6 is the item on tax. But item number 6, no adjustment actually, item number 6, because this is just for you to disclose. This is an example of capital commitment. You need to write down this in your notes to the account, and you just need to copy this and put in your notes to the account. Next is the item tax expense. So the tax expense was 5.5 million, and if you see here, there was already a debit amount of 4 million, so it is to be increased because of the charge. So you need to go and increase by an additional 1.5, because earlier there was already tax that you have paid 4 million, and the difference between what you have been charged is 5.4, what you have paid is 4 million, and that was some extra 1,500 that you need to pay to the tax authority, right? So debit taxation, credit, tax payable. So we will continue with the preparation in our next video. Go and take time to go and prepare the blank template and go and fill up the information. Thank you for watching. I will see you, and I will see you in our next video.